When will traders be willing to take on risk again? Binky Chadha of Deutsche Bank says that the great de-risking has already begun. He's got the most bullish outlook on the S&P among strategists from major firms. He's with me now live. Binky, I was reading your great de-risking piece here, and you say these pullbacks don't last longer than 2 months typically.
Yeah, the average is about 2 months historically.
Excuse me, I got a frog in my throat.
That's fine.
Pardon me. But when you look at the broad market, you see real capitulation at the 900 level.
At 9:15, we would be down basically 25% from the 1217, 1220 peak. And a typical recession sell down in the equity market has historically been about 25%. So that would be the equivalent of the market sort of pricing in a second or double dip recession, if you will. That's clearly not our outlook for the U.S. economy. We think the recovery thesis remains basically intact and on track. The market's clearly impatient with the recovery in the labor market so far. But there too, I would argue that if you look at labor income, which is the key driver of consumption, we are still very much on track. And what the trend is saying basically since the bottom in May last year is that jobs growth is going to kick in basically in July, August. So the market's going to have to be patient basically for a little while longer.
You're finding the greatest value in financials and industrials and in consumer discretionary stocks right now. Those seem to be referendums on global growth coming back, consumers perhaps pocketing a little bit more even if they don't have a job. But how do you reconcile these problematic housing numbers that we were reminded of once again today, that the housing market still isn't necessarily leading us out?
Sure. So we think basically that the driver of the U.S. recovery is really a necessary correction of the corporate overshooting. And so until basically corporates begin to spend and hire, we're not basically going to see the results of things that the market is focusing on. So instead of focusing basically on the consumer or retail sales, I would focus really on where corporates are. And as and when basically they begin to spend and hire, that's when you're going to basically see, jobs kick in, labor market growth pick up, and that's what's going to drive housing. So I would rather look at the cause and the driver rather than the result.
Binky, explain to me how you frame things these days, because you've got more market participants in the marketplace right now. You've got more kind of asset classes to play with. You've got ETFs and the like. So how do you use historical precedent to truly project what to expect this time around? Why isn't this time different? Every time is different, but every time is also similar. So it's important to keep both perspectives in mind. I would argue there's more similar than dissimilar this time around. Clearly, the severity of the recession is different. The combination with the financial crisis is different. And in terms of equities, I think key factor that has been missing so far is really equity flows, and so there's a lot of concern about whether or not this is a permanent change. But I would argue, and all the evidence in my view suggests that it's just like previous times, and until investors get a lot more comfortable with the recovery, you're not going to see basically that wider participation. And so volumes are going to be on the thin side up and until basically it's clear that the recovery is here, and basically the Fed is ready to embark basically on the next rate hiking cycle. That has historically been the point at which we've seen new inflows and participation into equity markets, and that is still our view that will happen and that will come.